One share makes you a part owner of the entire company. What can you actually do with that? And what do you earn? We'll cover your rights as a shareholder and the reward called the dividend, including why a stock's price sometimes drops the very day a dividend is paid. Owning a share gives you two broad things: a say through real rights and powers, and a share of the rewards, most directly through the dividend. Let's do this properly. Rights first, then rewards. Most beginners only think about one thing: the price going up so they can sell for a profit. That's real, and we'll get there. But ownership is far richer than just price. Owning a share gives you two broad things: a say through genuine rights and a share of the rewards, most directly through the dividend. Your first right is the most fundamental: your vote. Because a share makes you a genuine part owner, you get a say in the company's big decisions. The rule is simple: one share, one vote. You vote on the big structural matters, most importantly, electing the board of directors, and major decisions like mergers. You won't run the business, but you help choose and hold accountable the people who do. Where does all this voting happen? Mostly at the annual general meeting, or AGM, held once every year, where management must answer for how they've run the company, and owners formally vote on key matters. You don't need to attend in person. You can vote remotely, by appointing a proxy or voting electronically. It's your formal seat at the owner's table, even if you hold just a single share. Your second right is the right to information, and it's more powerful than it sounds. As a part owner, you're entitled to know how the company is actually doing. Public companies are legally required to publish regular, honest financial reports, annual reports, quarterly results, and prompt disclosure of major events. This transparency is enforced by the market regulator. It's what lets you judge whether management is doing a good job. Your third right is a claim on the company's assets, with an important catch about timing. If a company is wound up, its assets are sold and the money distributed. But there's a strict order. Lenders and creditors are paid first. Only after every one of them is fully paid do shareholders receive what's left, the residual claim. Last in line when things go wrong, but first to benefit when things go right. That talk of failure might make you nervous, so here's the single most reassuring feature of owning shares: limited liability. If a company you own shares in collapses under debt, are you personally responsible? Absolutely not. The most you can ever lose is the money you put in. The company's creditors cannot come after your home or your savings. Unlimited upside, but your downside is strictly capped at what you invested. Now we cross to the rewards, and the most direct one is the dividend. When a company makes a profit, it can share a portion directly with shareholders. It's typically paid as cash per share. If a company declares a 10-cent dividend per share, own 100 shares and $10 lands in your account. You didn't sell anything. This is one of the two ways shareholders make money: dividends, the income, and capital gains, the price rising. Many hugely successful companies pay no dividend at all, and that's usually not a bad sign. Paying a dividend is never compulsory. Mature companies often pay it out as steady income. Young, fast-growing companies often reinvest instead, telling owners they can grow that money faster than simply handing it back. If reinvested wisely, the company grows more valuable, pushing the share price up instead. Income now, or growth for later. Two simple measures help you compare dividends. The first is dividend yield, the annual dividend divided by the share price, as a percentage. A $100 share paying $3 a year in dividends has a 3% yield. Yield answers, how much income do I get for each dollar I invest? It lets you fairly compare a small dividend on a cheap share against a big one on an expensive share. The second measure is the payout ratio, total dividends paid divided by total profit. A payout ratio of 40% means the company pays out 40% of profit and keeps 60%. A useful warning sign, a payout ratio close to or above 100% can be a red flag. It may mean the company is paying out more than it can really sustain. Dividends follow a precise timeline. First, the declaration date. The board announces the dividend. Second, and most important, the ex-dividend date. You must already own the share before this date to qualify. Buy on or after it, and you're too late for this round. Third, the record date, when the company confirms exactly who the registered owners are. Fourth, the payment date, when the cash actually lands in your account. Here's the puzzle that confuses nearly everyone. On the ex-dividend date, the share price drops, often by almost exactly the dividend amount. That's not a loss, it's pure logic. The company just handed cash out, so it literally has less cash inside it, and each share is worth a little less. Picture a $100 share as $96 of business plus $4 of cash about to be paid. That cash leaves the company and comes to you. 96 plus 4 still equals 100. Your total wealth hasn't changed, it just moved from the share price into your pocket. One clean example. You own 100 shares trading at $500 each. The company declares a $15 dividend per share. You qualified before the X date, so you receive 100 times 15, $1,500 in cash. The share price adjusts down by about the dividend amount to roughly $485. Add it up. Your shares plus your cash are exactly where you started, just rearranged, and the dividends keep arriving as the company grows. One practical note, since a dividend is income, it's generally taxable. In India, dividends are taxed in your own hands at your income tax slab rate, with tax deducted at source above a threshold. In the U.S., qualified dividends are taxed at lower long-term capital gains rates, while ordinary dividends are taxed at your normal income rate. The details matter less than the principle. Dividends are income, income is usually taxed, and rules change. Always check current rules or speak to a tax professional. Let's line it up across both countries. Voting in person happens at the AGM in India, the annual meeting in the U.S. Remote voting is e-voting or proxy in India. Proxy voting in the U.S. Your right to information is enforced by SEBI in India, the SEC in the U.S., and on tax, India taxes dividends at your slab rate, while the U.S. gives lower rates to qualified dividends. Same rights and rewards, two systems. Let's gather it up. Owning a share gives you two things: a say through your rights and a share of the rewards through dividends. Your rights, a vote, usually exercised at the AGM, the right to information, and a residual claim on assets if the company winds up. Limited liability protects you. The most you can lose is what you invested. A dividend is profit paid out per share, but reinvesting instead isn't automatically worse. And the ex-dividend price drop isn't a loss. That value simply moves from the share price into cash in your pocket. So you now know what a share is and the full set of rights and rewards that come with owning one. But there's one thing we've kept brushing past. A share's price doesn't sit still. It moves every single second the market is open. What invisible force is constantly deciding that a share is worth one price, one moment, and a different price the next? That's exactly where we go next. If this gave you a real understanding of what owning a share actually means, the powers, the dividends, and why that price drops on the X date, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. See you there.